Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Nick Jones has been involved in commercial real estate management, investment, development, and brokerage for over 20 years. Each role has added valuable perspective, introducing various angles and strategies to evaluate every opportunity Alakai Capital pursues. Currently, he serves as CEO managing acquisitions, development, and capital markets. Throughout his career, Nick has underwritten and acquired over 70 commercial investments and developments representing more than $250 million in value. He currently oversees 800,000 plus square feet of industrial, retail, office, and medical assets. And by the way, he was also, while graduating summa cum laude from the University of Central Florida, he was simultaneously competing in the World Tour as a professional wakeboarder, earning a podium finish at the World Championships in 2011. Wow, that's pretty impressive. So I want to get into and talk about your journey as a real estate investor. And I know you do a little bit of dabbling in some angel investing as well. And I want to hear all about that. But, and I want to hear a little bit about this wakeboarding stuff. But before we go into any of that, I want to take you back to when you were growing up, maybe 10, 12 years old. What did you want to be? Because I'm guessing a professional real estate investment and developer and manager or angel investor, or maybe even, I don't know, wakeboarder was not it at 8, 10, 12. You tell me.
So it's actually interesting. When I was probably 8 to 12 years old, I'm trying to think of exactly when that was, but I was growing up in Redmond, Washington.
Okay.
And that was, down the street from Microsoft and from Nintendo.
Yeah.
And around that time was when Microsoft was really taking off. Nintendo, I think, had the Nintendo 64 out. It was the first 3D, graphic cards. So everyone thought it was photorealistic, and looking back, it's anything but that. I grew up around real estate. My father and grandfather had taken a foray trying just about anything within real estate. And at one point early on, I remember there was a warehouse building they were working on, and Microsoft went them wanting to do a green room at that warehouse to film for one of their video games, like the action sequences between the gameplay. And I'll spend all my time playing sports, playing video games, going to school. And so my father came home, and real estate seemed incredibly boring to me, mentioned that to me. It really stuck with me, like obviously to the point that I'm still remembering it now. As I grew, the importance of it changed within my mind. And what I got from it was that, he was good at one thing, which was real estate, but yet he was able to meet fascinating people across all these different industries. And that one, was Microsoft at the time, which was very fascinating to me because it was into video games. At that time, it kind of planted the seed for real estate, but I probably wanted to be, a professional athlete of some regard. And then, as I got a little older into high school, being a professional snowboarder or wakeboarder was what I thought I would do forever. And I pictured myself, maybe in my 60s and 70s, I guess, doing those action sports. Most people are probably aware, when you're 25 years old, you're washed up. And so I did get to that point, but I got spit out pretty quick.
Got it. Well, listen, at least, there aren't many people that get to the World Championships in anything. So, so you had this spark, right? You thought wrestling was boring. Now you have the spark because of the games. Tell us, how did you end up? Like, did you go straight into real estate early in your career, or was there a journey to get there?
There was definitely a journey. So there could have been a direct route with, like I said, my father and grandfather were both in it. They both unfortunately passed away when I was right around my senior year of high school. So the trajectory I was going would have been kind of an easy cruise control in. I was registered to go to Arizona State University, and probably roll into that. But with the passing, which was abrupt for each one of them, I pivoted and decided to pursue a professional wakeboard career. And so dropped everything, moved down to Florida, and to the point where I had, no class schedules. I didn't have a place to live. I ended up living for a few weeks in a frat house at UCF. because a friend of a friend knew someone that was there. So flipped my life upside down, for my passion of wakeboarding and going down that direction. I started, at the bottom and had to build my way up. And, it taught me a lot of, hard work and resilience that I'm sure, we'll talk about during this conversation. But after that, I remembered real estate from when I was a child. I remembered that, that Microsoft story. And so I decided to go to class for it, take a degree in real estate. And the dean of our real estate school was, his son was a pro surfer. And so he took an interest in chatting with me because he knew that I was, a professional wakeboarder at the time, and really drew my attention back to commercial real estate. And, he was a great academic because he was also a practitioner. And he'd built real estate companies in the past, made it seem really cool to be an investor and a developer. And so it piqued my interest, and that's really what pulled me back in and deciding to get into the industry after graduating from college.
So, what was your first deal of any type?
So after college, I got into brokerage, and it was land brokerage at the time. And so this
Okay.
was about 2011, 2012, which I don't know if you can remember, but in Florida especially, which is where I'm based, land was worth less than the buildings next to it. And so when I was cold calling people, it was probably similar to, a timeshare salesman, where the second you say a word, they don't want to hear from you. Developers were reminding me about how my land had no value whatsoever. So it definitely helped me cut my teeth. But at the same time, those communications with the developers were just super exciting to me because they were out there, figuring out how to create value, and they were, changing communities with their projects. So through my friends at the real estate program in college, I kept on talking to the other brokers about wanting, to get a deal done. The first deal that came about was through a friend who was a broker of mine who had noticed a vacant Taco Bell that, he thought a tenant that was expanding the market would have some interest in it. So put it under contract, worked with him to get a lease signed with the new tenant. We signed a 10-year lease. We only had to replace the HVAC and the roof. And looking back, that was probably the hardest deal I had to go through, really cutting my teeth, learning about the various paths of, replacing a roof and installing new HVAC. But at that time, the market was really strong. So I got 80% value on my loan, 2% interest only. And so I was able to flip out of that. And it's still one of the strongest returns I've had in a deal. And so from there, kind of cut my teeth and then did a bigger deal and took off.
You said, like, a lot of people that I know, that I meet, that I've interviewed in the podcast, start in residential. Like a lot of, start in like fix and flips, and then maybe they do a multi, and then they eventually get to commercial real estate. You started with a commercial property. You started with finding sounds like, was that a triple net lease,
Yep.
kind of situation, right? Which I figured for that kind of property. So it's interesting because, a lot of people I know build up to doing commercial retail and that kind of stuff after starting, but you didn't do that. You hopped right in.
Well, what I like about commercial real estate is that, you have a really strong partner in your tenant.
Yeah.
And with almost all residential real estate, they're speculative investments. You may have tenants in there when you buy, but when you develop, you're developing just based on, market demographics and your projections on expansion in the market.
Yeah.
On that first project, and most of our projects at this point, going forward, we're finding sites that we know tenants that want to be there. We're signing leases with tenants a lot of times before we close. So there's a individual or group, on the other side of the table who agreed to 5 to 20-year leases with us that have proven business models.
Yeah.
And so there's a lot of safety in that within our business model. And when we're looking at deals, the last thing we ever want is a deal that has, significant downside risk. So we hedge that with, strong tenants signing leases. So then, we believe that creates asymmetrical returns, which bode well for us over the last 10 years or so.
Let's start with that first deal and talk about how it's evolved in terms of financing capital partners. Whether are you doing SPVs, are you doing a fund? Was that your own money on the 20%, you had to put down on the first deal? Like, talk to me about the financing / capital evolution in your deal journey.
Yeah, that was great because it was lucky timing where we were in the market cycle. 80% loan to value is not something you get very often. It was a smaller deal. Myself and one of my brokerage partners were the two that invested in it.
Yeah.
So, it worked out really well because you wouldn't be able to get that today in a lot of deals. From that point, rolled that into one other deal that was, somewhat similar. But Real estate's very capital intensive, so I quickly ran out of capital, especially starting from a brokerage perspective. Came across a deal shortly after that a fellow broker in my office was selling, and it was an old bank branch that I was planning on tearing down and building a QSR, a quick service restaurant on.
Yeah.
So being that it was the first deal I was going to raise cash or raise equity for, I didn't want to put any debt on it because the one thing you really got to focus on, especially when you're raising outside capital, is protect your downside risk. And so early on in the game, I figured, well, if we buy it all cash, that'll give us time to carry the property. We put reserves for 2 years of interest and taxes. And I went out to my friends' parents, my friends, other brokers, really anyone that I could. I put together an investment memorandum of things I'd searched online. So I spent a ton of time in the details. Some of the details were irrelevant, but regardless, you're kind of just wanting to make sure you cover every basis. I was able to buy that cash, and shortly after got lucky with a tenant coming to us and saying that they wanted to lease the existing building. They would take it as is, gave us 10-year lease terms. And so without having to have any extra money out of pocket, we're able to sign a lease on that deal. I refinanced it 50% and took the 50% equity we got out of that to buy a second deal at 50%. So at this point, I was starting to have a track record. The initial investors who had one deal had two deals. That experience of working through the projects started to create a snowball effect in my experience and then, my investor base. And, have now grown it to where we have, about 100 investors who have done about 500 investments with us.
Is it all on an SPV basis? You haven't done a fund, or how have you been doing it?
Funds are a big topic in the industry, and a lot of people obviously do funds. We've looked at it, for years, if it makes sense. We currently syndicate every single deal, and we haven't had an issue thus far with the time it takes to raise the capital.
Yeah.
So we've continued to do that model, and it's nice for our investors because they can see most of our deals look the same. Our thesis on returns tend to rhyme. Maybe a different property, different geographic location, but our minds are pretty similar across all deals. And so for them, it's nice because they get to pick and choose to some extent which geographic locations, which product type they like. And for us, as long as they continue to, invest in the time period that, we need in order to close on the deals, the syndications work great and it seems to work for everyone.
I was going to say that's the key factor, right? The biggest, I mean, it's not the only one, but the biggest reason, and it's why at some point, a long time ago, I raised a couple of small funds because we missed out on some really good deals because we couldn't put the capital together quickly enough. So
Yeah.
if you can do that, if you've solved for that because your investors are quick to decide and fund, then there's less reason to put together a fund.
It's not without stress. We go through the due diligence process. We're generally hard on a deposit. We're going towards closing. We package it up and send it out. And, if it works, great. But there have been some times, on some of the larger deals, it can be a little long days, making sure you get the message out to everyone and going through, the underwriting of the deal with the investors.
Even if they might be interested, they're not too busy to, focus on it and get their
Yeah.
attention and all that kind of stuff, right?
Yeah, hopefully they're all on summer vacation.
Let me ask you a question, sort of going back to this initial decision to raise outside capital, because I'm always interested in this. And I have often asked guests, and, I went through it myself because I raised outside capital for some real estate investments, as I mentioned, in these small funds years ago. There's something about the minute you take other people's money, unless you just don't care about people and you're a psychopath or whatever, or, a narcissist, which I know you're not because we know each other. Like, it is a decision, right? You're now responsible for other people's capital, right? And some people, frankly, can't handle that and will never do it, and other people do. And even the people I do, I know sometimes, like, were you comfortable with that from the beginning? Was that something your father and grandfather did, so you had a model on it? Was this sort of a journey or a thinking that you had to go through to be willing to, sort of be responsible for other people's money?
My grandfather and father had never raised outside capital. They had the old school approach of just, slowly growing, as I think traditional real estate. The idea of fundraising and bringing outside capital was something I learned about in school. And it was very foreign at first. And it is a lot of weight on your shoulders, similar to personally guaranteed loans. And so, you get to a point where the weight is something you get comfortable with. You appreciate it. I mean, we're very detail oriented, but I have to believe it makes us more detail oriented because you can, lose your own capital and it would be unfortunate. You may cry one night, but if you lose someone else's capital, it's a completely different aspect of the business. So, it's something that we still think about now, and it really makes you make sure that your deals are underwritten correctly, that your reserve accounts are funded correctly, that your, projections aren't too optimistic. You would rather under deliver to make sure that, we can get those returns. But pretty early on, I jumped into it. It just felt like a natural fit. And, the investors we worked with, it was pretty fluid with them as well. It was a lot of people that I'd worked with for quite some time. And, I think that when you're very transparent about the downsides and upsides and about, all the aspects of the deal, that there's a lot of trust going in that, these deals would make sense. And so, it was just like a fluid initiation building up.
I don't know, even, a super successful investor of any type, whether it's real estate, whether it's angel, whether it's whatever, who hasn't had at least one that hasn't worked out like they would like. Have you had one or more like that? And what were the, in hindsight, either the lessons or the mistakes, or, for us, we were one of the funds we raised was in 2007. For us, we actually hit every target we had control over. And then, of course, the global financial crisis came and,
Yeah.
we got hurt on a couple of our investments. And my only solace was, and we had other people's money, and my only solace was that they were way bigger, smarter, real estate investors who got hurt at that time as well, So any interesting stories or lessons from, the quote unquote failures, or the ones that didn't work out as well?
I wasn't, working through the great financial crisis. So, and that's always been something that's concerned me, because people have gone through that. They learn things that you can't read a textbook about it. And so not having experienced that, there is a lot of mixed data out there right now and mixed opinions. And so it's constantly something that we're analyzing, and that I'm analyzing to see, if what's going to be something that, tips it one way or another. As far as our track record and deals that haven't gone right, we've had deals that haven't gone down the path that it was designed to go down, whether it be, tenants bailing out on leases, which is mostly the situation we've dealt with. Sometimes just things don't lease up as quick as we thought within a market. What we've learned is, I guess the biggest lesson I've learned from this is that the contracts matter, but the people matter just as much.
Yeah.
And so when I say that, there have been some leases we've signed where, you send it to the tenant, and these are 10, 15-year leases. They're pretty big deals. And they've responded either, quicker than usual without any, red lines, to a point where you're wondering the amount that they're looking into it. And little indicators like that are things that we really take note of now. And we try to get to, as high as we can within the organization, if it's not like a credit tenant. So obviously when we're negotiating with, Dutch Brothers or Chipotle, we're not going to try to talk to their CEO. They have a strong track record. The name on the lease is pretty comforting. But when we're dealing with, whether it be local tenants or regional tenants, expanding tenants, it really matters to us understanding the business model, understanding, their track record, and focusing more on, the individuals behind it as much as the lease. Because, if a tenant leaves in the middle of the night and you're going down the legal process, no one wins. It's a long process. And while you're doing that, you still own the building. You still have your debt payment if you have debt on it. So then, we're out doing, what we were doing in the first place, finding a tenant. It creates challenges for the business. If you buy the building right, then, generally you can find another tenant if it's, underlying good quality real estate. But if you do a good deal on bad dirt, you could be in trouble. So we try to look at it, is this a good deal and is this good real estate? And if it checks both those boxes, we feel pretty comfortable moving forward on it. So to answer your questions, we've had some tenants that have given us, some challenges over the last few years. We've had to pivot and, reposition properties for.
It's interesting because you talk about these credit, high credit tenants, and you're right. I know people who do those deals. Obviously, there's a safety in them. There is once in a while where one of these, seemingly blue chip tenants turns out to declare bankruptcy, whatever. And I know a couple of folks who had an over concentration with some of the, I think it was Rite Aid or whatever, like where they had a lot of their properties with one particular tenant, and they ended up getting hurt. It raises the question, like I don't do as much on the real estate side. I do a lot on the corporate side. And I remember, back in the day, when I represent sellers to big companies, even public companies, right? It was very difficult to get what we call reverse due diligence, right? They'd be like, what are you talking about? Where's so-and-so?
Yeah.
are listed on the stock exchange. Like, go look at our public information. That's what you get. Or if they were very large privately held companies, they were like, no, I'm not sharing my financials with you. Come on, we know you. And then Enron and WorldCom and some of those other things happened, right? And it gave us more of an argument to say, everybody thought Enron was this huge company too. I'm curious on like the level of due diligence access that you get from these, seemingly and mostly truly blue chip kind of, tenants to be able to do any kind of due diligence on that level of company.
It's all over the place. So some of the larger tenants that are public, obviously say just go look online. The larger private tenants, a lot of times you can get financials through signing non-disclosure agreements. We've had several times where they're private and they're pretty large and they think they have, a huge advantage in the market and they don't want to share. And so we've had to jump on the phone with, CFOs and have conversations that, can't be in writing. And obviously that's just, someone's hearsay. So you have to have a level of trust in that as well. It can be a challenge, underwriting the other side of it. And so when that happens, you have to underwrite, how much tenant improvement allowance are you giving them? How much are you putting up to build out their space? What's your basis in the building? Is their success the success of the whole project? So, if you have a strip center and this one tenant blows out, how relevant is that? Are they at or below market rents? There's a lot of variables you have to ask in that part of it to measure, the risk of the deal. We've also seen on the other side, which was really interesting, because we do a lot of small bay industrial deals. And those are generally, blue collar, mom and pop type groups, mom and pop that, are 3,000 to 10,000 square feet. Sometimes they're regional or national. Other times, it's the business owner's working there every single day with his 5 employees. And when COVID hit, we experienced, and the market saw, these various credit tenants that their attorney said, hey, stop paying rent. We don't know if the world's going to end. So just why would you pay rent? We obviously still had to pay our debt. Lenders weren't saying we didn't have to pay our mortgage. So, people were getting squeezed by, these tenants for a few months that were, the high quality groups not paying. Meanwhile, our small bay industrial tenants, were calling us on the phone saying, hey, just let you know, we're all right. We're still working. We got rent coming in. It was like this relationship because there was actually, the person that owned the business that knew us as their landlord.
Yeah.
And so they all came through and we didn't have any delinquencies from any of our tenants of that nature. So it almost like flipped the idea of creditworthiness, on its head, which again, just goes back to the people.
Yeah. In terms of how you source properties and, evaluate them, how do you do that? How are you finding your deals?
So majority of deals we find right now are through brokers who, we've just built long-term relationships with. And the value of these relationships are A, that they trust that we'll be confidential on information they send us.
Yeah.
B, that they trust that we'll move quickly and decisively underwriting deals, going through the process. And C, that, they know how we think. So a lot of times, they'll call us and say, hey, this is a great site or a great deal because of X, Y, Z. And we may disagree with them, but, us constantly year after year bouncing deals back and forth, we get to know kind of what the touching points are, what makes sense. They know what tenants we're working with. So they may say, hey, there's a site over in this market and we know it's a gap for this tenant. And, we'll be able to get a quick read from our guys. So it's been a really good source of deal volume for us. And of course, they're making money while we're making money. So it creates a lot of good synergy. And that's helped us, expand across Florida. Now we're building relationships, outside the state. So we're doing a deal in Texas, California. We have a few up in Seattle. And when we have a deal, we're doing everything on it, right? Like we do the management, asset management, property management, accounting, acquisitions, the capital markets, development. So we're doing a lot of things while we're underwriting deals. And these brokers, their job is knowing the market. So every single day they're out there understanding the market, who's moving where, where it's going. So the amount of, knowledge that they have really helps us get through deals, underwrite them quick, and be able to, move on transactions that make sense for us.
Yeah. And, some of the things you talked about are key when you work with brokers and the industry. And by the way, it's true on, in other industries with key intermediaries, is if they can have somebody who they know, first of all, they get to know, so they know what you're more likely to be interested in, what you're not interested in, so they don't have to waste time on that. They also know how to speak into your language. Like, they know the questions you've asked on the last, 3, 5, 10 deals, whatever. So they're going to answer them and they're going to have that information ready for you in advance because they know you're going to ask about X, Y, and Z. And they also, and this is the key point you raised, they know that you're quick to decide, right? And obviously If you're quick to say yes, then that's great for them. But frankly, if you're quick to say no, then that's actually the second best thing because they know they don't have to waste time. They can move on, right? To
For sure.
maybe another, so they really value that. And you're right. I mean, they're going to bring more and more, deal flow to you, which is phenomenal. Now, what I find sometimes is that, there's a discussion, of course, everybody wants to find these off-market deals and, the ones that aren't through brokers or whatever. But I also find, especially in commercial, that when a lot of times, even the broker deals, it's not like, they're putting up on an MLS like a residential deal, right? Sometimes even if it's through a broker, if they have one or two or three key people that they might, it's not like they're blasting this out to 100 potential buyers, right? A lot of times they're directing it to who they think is the best fit and given key, good relationships, the early shot on these deals. So it's almost like in commercial, my experience is that it's, even though it's through a broker, it's sort of in between. It's not totally off market. And you do have an intermediary, but it's not like they're shopping this across, they're creating a process like an investment banker would do in selling a company when they're trying to bring a bunch of people to the table necessarily. Is that your experience?
The whole idea of off market is so interesting because some of the off market deals we see are being sent to us by, a dozen brokers. Some of the on market deals we see, the information we know is, not widely known. So it's somewhat off market.
The deal's on market, but your information is off market.
Yeah. So, a lot of the deals we do are off market. I mean, they're not listed somewhere, but, people are pretty aware about it. There's a lot of transparency right now, with technology and people being able to find deals, get a hold of owners, way more than ever before. And it's changing, monthly now. The idea of off market's dissipating. It's more about seeing all the aspects of a deal and being able to come up with your investment thesis quickly and efficiently, and then jumping on it probably quicker than, someone else who's similar than us. So what we've found success on these deals, which like I said, some we see before others, most of them, we're probably looking at the same time as others as well, is, we have really tight relationships with pretty much all of our vendors. So, when it comes to renovating or developing new projects, going through environmental studies and all the various upfront studies, we're able to do it quickly and pretty efficiently. And so a deal that, maybe someone else couldn't pencil, we're able to do so because we're just, very efficient through our processes and detail oriented. A lot of times, especially with our tenants who, are our biggest, other than our lender, our biggest partners on these deals, what's a win for them may be different than a win for us. And so when we're negotiating leases, we're saying, okay, we got to make the economics of this make sense. What do you guys really care about? And sometimes it's, more TI than anything else. So then, if we can increase the term or increase the annual bumps, and that makes sense for us because we negotiate a longer interest only period on the debt, we're the only ones that sees all the different levers we have. And so that's what makes the difference for the deals, for us. But everyone loves the idea of off market. It's just, there are so many deals out there that are not on the market, but they're just being blasted right and left between everyone. And then just because people love that, they jump into it more than something listed.
Yeah. So in a little different direction, we can come back to real estate in a bit, but you dabble, let's say, or play in some angel investing as well, right? And and it's interesting because there are some folks who have all the net worth or most of it in their business. Some of them actually dabble in real estate investment, right? It's not what they do every day, but they maybe some of your investors, on these deals are people who are focused in making most of their money elsewhere. You make most of your money in real estate, but you play in a little bit of angel. Talk to us a little bit about sort of your approach to the angel investing that you do. I know it's not your main thing, but talk to us about how you think about that.
Yeah, angel investing's it's fun, it's interesting, and it can be very exciting. So early on, when I was first getting into real estate and wasn't quite sure if it was a direction I wanted to go in, I was going to a lot of the startup meetups and pitch presentations, whatnot around Orlando and some of the neighboring cities, and was really fascinated by the ideas people would come up with. And a buddy of mine, saw a pitch from a fintech startup here in Orlando that seemed pretty attractive and invested early on. And, fast forward a few years, ended up hitting pretty well, and it became the first unicorn to come out of Orlando.
Yeah.
So, by luck, got a taste of, what that can look like. And, with that luck, we figured, okay, maybe this is something to lean into because there are just so many, creative minds out there. And the difference in, this angel or, early stage VC investing is if we continue to be incredibly successful in real estate, we're going to hit singles and doubles all the way to the Hall of Fame. That's the name of our game.
Yeah.
And there's nothing wrong with that. That's what it is. It's consistent. You're focused on getting on base, to use a baseball analogy. These angel investing deals, you have potential to hit home runs or even, grand slams. Since those don't exist in commercial real estate, I liked kind of the differentiator of continue to be consistent on the real estate side and then swinging for the fences a few times on angel investing deals. And so myself and, a few other people I know that are in real estate, some are in other industries that just like to have exposure deals and underwrite them. We've constantly been looking for different angel deals. And if something, comes across our desk, one of our desks, through our network, we'll get together and chat about it, look at the size of the market, look at the founders, look at, the trends of it and whatnot, and see if it's something that seems like it could make sense to invest in, which is generally, tech related because, we want to hit those 10x plus deals, 10 to 100x. And so in order to have that, it has to be something that can scale significantly quick. And what I've started to see is you only get so many opportunities to have exposure to those deals. The companies that have grown that you hear about, they're household names now. If you said, okay, I'm willing to risk money in angel investing, that's not getting you very far. You have to have exposure to those deals. And getting the exposure to them is really hard because a lot of people out there are looking. And so for us, it's, if we even have a chance to see the pitch to hit that grand slam, we're going to try to jump in and swing on it, assuming that it meets all the characteristics of having that potential for that growth.
Yeah. You mentioned to me a little bit, just in our prior discussions that because you're so focused on the real estate side, that you sort of rely a little bit on your friends who are more focused there and do, a bit of a tag on a co-investing. Not that you don't look at it yourself, but, obviously, you said to me, right, they come for you to real estate investing advice and you sort of, rely upon them a little more because they have more space and time and focus on doing some of that due diligence on some of these companies, right?
I guess I'll kind of relate this to my investors. A lot of my investors are first generation, or if they're second generation, they're doing very, very well for themselves. They're the ones kind of the breadwinners.
Yeah.
And so, I'm talking to people almost every single day that are in other industries and they're absolutely crushing it, whether it be an employee, a salesperson, or it's their own business. And they look at us as, their commercial real estate arm. And they're pretty much saying, hey, I'm really good at making money, growing wealth in one aspect. But if I want to have allocation to commercial real estate, Nick, I've selected, you and your company, and I believe in the direction you're going with the commercial real estate space. And I think of, my angel investing in a similar way where the guys I co-invest with are generally a little more knowledgeable on it, a little more, have a thought process where they can underwrite deals and think the variable is different than mine. I've learned that's not going to be me. I'll provide my input where I can and as I see fit. But, I try to partner up with, other individuals who have more expertise on it. And it's thus far seems like it's working out. We have good valuations on different portfolio companies. Obviously, you have to get to an exit or else it's just
Sure.
a number on a piece of paper. There's a lot of exciting growth out there with, various aspects or various areas of the tech world right now.
Yeah, no, love it. I do the same thing. I sort of dabble, for me, it's always money I can afford to lose, right? It's not where my major part of my investments are. Hey, listen, in my mind, it's better than playing the lottery because at least you can do some evaluation and whatever. And there's a huge upside and it's not just based upon chance. And also I love supporting entrepreneurs. I love studying these models and seeing what people are looking to build. So it's fun for me. And I understand that with the reward, there's risk. And, a lot of those investments may very well go to zero. And listen, when you understand that major PE and venture funds, if they hit huge on 1 out of 10, and then on 2 others out of 10, they do okay, but it's not big, and 7 out of 10 go down, that's a great ratio and result for professional investors. So when you understand that and you come into the mentality from that point of view, if you're going in with dollars that you really care about and you're betting on one company becoming a unicorn, that's not the smart way to go.
Very different than real estate.
Yeah.
It's a very different muscle. It sounds like you've done a good amount of it as well. It sounds like, you tell me, but I feel like every single time I look at a company, understand how they operate, I'm learning something.
Yes.
That, I don't know where it's going to apply somewhere else, but you're just kind of building up a knowledge base that is important.
Yeah, 100%. So the last topic, maybe before I come to my final 2 questions, in terms of any trends you see in the marketplace, whether it's, overall or, in Florida or, obviously in commercials where you focus. And I hate when these prognosticators come on and talk about generally, there's segments, there's geography, there's so many different things that are affected differently by different factors. But in terms of, what you're involved in, there's some interesting mixed, signals, right? Obviously, you've got interest rates where they are starting to maybe ease down. You got fears of inflation. Tariffs may not affect you. They may, depending upon whether they're affecting tenants. Obviously, maybe even in building material costs, stuff like that. There's a lot of different factors that are moving in different directions. Stock market is strong. Unemployment's still low, but it looks like it's ticking up. I mean, on and on and on and on. Saying a crystal ball, like what factors are you looking at and how are they impacting your, analysis and decision-making going forward? Because listen, as entrepreneurs, as investors, despite the fact that we know we don't have a crystal ball, we've got to evaluate things and sort of take some bets on what we think is going to happen, and we're either right or wrong.
So we are watching interest rates, same as everyone else. And when interest rates go down, there is near-term positivity in the investment world. So, obviously if we see another 25 or 50 basis points, that would, help on liquidity on exit to investors on our deals. And on our interest rates, we can lock in going forward.
Yeah.
As far as if that's positive long-term, that's a very deep discussion you can have. What the median interest rate should be. And if we already spurred it too much and now we need to go through some pain from, a large scale economic viewpoint. But, we're not trying to, underwrite that whole project or discuss that, especially right now.
Yeah.
That's something we all often think about is, near term, what's the benefit? And then long term, what's the benefit? Because some of our properties, we underwrite to get in and out of in 12 to 24 months. And other ones, they're more 3 to 5 year holds. So, you have to look at it from both perspectives. The inflation play is still very real. It's bulky. You see it hit some parts of the industry. You haven't seen it hit others. And so with that bulkiness creates inefficiencies and opportunity. And a lot of our, bets and investments are wrapped around that as well. We're also seeing that people really like experiences and getting out. And so, there's this whole retail apocalypse thing that they were mentioning after COVID. And, a lot obviously has gone online. But people still want to go out. They want to go to their restaurants. They want to, go and, get their nails done. They can't do that online anyways. People enjoy interaction. And so when you can buy properties that are, as close to, pedestrian friendly areas or are just things that are more service industry, we're seeing a lot of benefit towards that. A clear trend is obviously drive-throughs. I think everyone knows that. Efficiencies in the average American's life as, we all are working more. We have less time. We have more things to do. So, almost every concept's figured out how to use drive-throughs. And the crazy part is like every single one of them, it's working. I mean, example, Chipotle, you wouldn't think a drive-through would make sense at first, but, it's really proven a success for them. So, Americans are saying, yes, like give us more efficiencies on these types of projects. So we're seeing a lot of different trends, across those aspects, enough for us to continue to, we have 4 or 5 verticals we invest in. Just what I was just mentioning keeps us very busy.
Love it. So, is your investor pool set? I mean, I almost don't know a developer and investor that's not always open to more capital, So in terms of like, are there opportunities to invest in deals coming up? I know we're not making an offering on this podcast, but, just in general, is that something that people can find out more information about in terms of your deals, and where would they go?
Yeah, we're always open, to meet with new investors. I think I mentioned earlier, we have about 100 investors right now who have taken about 500 LP positions. So, on average, that's 5 per investor. Obviously, some have done much more. We've had some that have invested 20 times and others have just met us and they've invested 1. So it just proves we really care about, the relationship. We're leaning heavier and heavier into education because we've seen that the more we talk about the deals, the more we talk about how we think about the deals, it educates our investors, and that makes them better investors with us, better investors, if they want to go look at other types of commercial real estate. Yes. And so it just, improves the whole cycle and relationship we have with them. So, if anyone's interested in talking to us, I obviously love talking about commercial real estate, and I especially like talking about our deals because every single one is, is exciting. It's us, solving a puzzle, and then, getting to share with our investors, hey, here's this, solution we found on how we can create alpha and, make some money. So you can go to our website, which is Alakai, ALAKAI -capital.com. And then there's an invest with us button that you can fill out, and then we'll set up, an introductory call and chat with them about, what we do. Yeah, I'm also pretty active on LinkedIn. Just started picking that up this year, and it's a really fun place to, just share thoughts with like-minded people. And it's It's been really fun because a lot of the, brokers I work with, a lot of the investors I work with, my lenders are all on there. So it's kind of a place that we can all just chat about, how we look at business and, its intersection with life and everything else around it. So if you message me on LinkedIn, I'll respond to that as well. Definitely open to conversations. Love to talk about, the things our company is doing. So we're really proud of our work and like to share it.
Nick, my final question of the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world, from people from oppression to why I haven't had a boss in decades and, and never, been an entrepreneur. What does freedom mean to you and how does it impact your life and business?
Wow, that's a great question. So I guess what freedom would mean to me would be the physically being able to do what I want, mentally having the option to, choose the thoughts that I have, being surrounded by the people I love. So that's such a good question because a lot of times you lose freedom in order to try to gain freedom. And the balancing act in life of gaining your freedom is a real tough one that I think, especially in American society, we're really juggling. And there's a lot of people talking about it right now.
Yeah, absolutely.
I'm not quite to the freedom that I know we were talking about before that you've figured out with your company. Because I'm still in heads down growth mode, but freedom is a goal for ourselves, our team, our investors. So it's something to definitely shoot for.
Love it. There's so many aspects of freedom in life, but I appreciate your answer to that, and I appreciate having you on.
There's one thing about that. When you say freedom, I think so many people think financial freedom.
Yes.
And that's just such a small aspect of freedom.
Yes.
I mean, if you gain financial freedom, but physically you're not there, or you've isolated yourself from people you love, there's so many aspects to that thought that, people should value.
Yeah. It's funny. It ties into a concept, which I won't spend a lot of time on now because but I love this little dialogue here. I have this concept that I live by called ideal life now. I'm not waiting to retire or sell my business or whatever. It's how about the idea that we create a life that there's nothing, what would I retire from? If I have my ideal life now, and I'm doing the stuff I love in my business and I'm being able to be in Bali and I have time with my wife and friends and, my dog and whatever it is, right? And I can pursue my passions. So, for me, they're tied together, right? And ideal life can mean a lot of things to different people, whether that's impacting the world or philanthropy or building the next unicorn or whatever it is. But yeah, I think it's an inquiry I've been in for a long time. And that conversation for me keeps evolving.
Geez, I wish I asked you more questions through this interview. I love that idea.
Talk more about that. Absolutely. Nick Jones, thanks for being such a great guest on the DealQuest podcast.
Thanks, Corey. It was a pleasure.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com. And if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.